Ladies and gentlemen, good afternoon from Athens. I am Alex Benos, the CFO of CENERGY Holdings, and I'd like to welcome you to today's live webcast of our company's 2026 Q1 condensed financial results. I would like first to highlight the main points of our Q1 of 2026. We had a very good start of the year with record margins. This exactly demonstrates the success of prioritizing value over volume. Demand is really strong. Demand is also structural, and that underpins further growth for our companies for the rest of the year and in the medium term. The first key highlight I would like to stress is that operational profitability surpassed 100 million, is actually equal to 100.4 million, due to a very favorable product mix of cable projects, which are heavily tilted towards offshore cables for Q1. Revenue growth is moderate, 5% increase over the corresponding first quarter of 2025. A total of 511 million, as the new capacity of land cables that we have developed in both the Thiva factory and the Eleonas factory are gradually coming into play. The backlog is still stable. I would put that word in quotes, around 3.3 billion, and I will explain in a while why I do put it in quotes, because that may give the wrong signal to you and to the rest of the investment community. The fourth point is that our strategic investments in the U.S. and the U.K. are developing as originally planned, and I'll give you some more information on both of these. Margins are at record level at 19.7% for the group, with the steel pipe segment still surprising us positively. The margins are expected, of course, to normalize by year end. And when I say normalize, I mean that we are expecting them to be 1 to 2 percentage points lower. And I'll give you an explanation for that too. Net profit reached 74 million, a very strong number for a first quarter, and earnings of 35 cents per share. We also confirm guidance of 370 to 400 million adjusted EBITDA for 2026. As pointed earlier, the performance is very solid for the first quarter. If you look at turnover, all first quarters have a positive increase in sales. Adjusted EBITDA is increasing by around 30%, more than 30% from the corresponding Q1s of previous years. The same thing happens for EBITDA without the adjustments. So the number that includes one-offs, the difference this year comes from a positive metal result. Here we have increases of more than 45% year on year. And PBT, as well as profit after tax, also increased by more than 70% year on year for the last 2 years. So these are very strong results, which are due overall to an improved sales mix. Now, if we take a magnifying glass, I would say, and we look at the quarters, the last 4 quarters, plus Q1 of 2026, let's look at what we observe on our screen right now. Our business really is a seasonal one. And when I say seasonal, it's not because it depends on good or bad weather, but because we are an energy projects enabler, and these contracts that we execute have, in a sense, their own life cycle. Usually, the year will start slowly. Q2 will be a little bit stronger. I'm talking about profitability. Then, as the pace will pick up, then Q3 is usually slightly slower due to the summer. I remind you that we are selling, our geographies of sales are mainly Northern Europe and North America. And Q4 is coming strong as clients rush to close the projects delivered to them, but also to secure capacity for the coming year. 2025 was almost like this, with the Q4 being a little bit slower, not as strong as we expected it, but still a very strong one. This year, Q1 surprises very positively. It shows an abnormally high percentage of offshore projects in the cables revenue, and these projects, as you all know, contribute margins above 20% for the segment's revenue. While the Corinth Pipeworks company, our steel pipe segment, continues to have high EBITDA projects in their backlog, and they continue to execute them. So the 19.7 margin that we observed in Q1 of this year is expected to go down, go back to a more normal level of 17% plus, as land cable projects will pick up execution in Thiva and Eleonas. Both do have this extra capacity added throughout the previous 2 years. You remember that investment cycle mostly finished by December 25. And these land cable projects, they contribute to our cables revenue, but with lower margins than the offshore ones. Therefore, the average number that we will get out will get back to a lower level, to a less extreme level, I would say. Turning to backlog. Backlog is a very interesting number because it might give you, if you look at its stability, in quotes, I put this word, it may give you a wrong impression, a wrong message. First, I would like to stress that there have been 2 projects awarded and disclosed in Q1, one in Poland and one in the Netherlands. Alliander is one of the major distribution operators of the country. The total backlog is 2.7 billion in cables and another 600 million in steel pipes for a total of 3.3 billion. It remains very well diversified, both in geographies and in energy applications. You see that we are not really serving only interconnections or only CCS or only Europe for steel pipes. We do have a diversified backlog portfolio. But still, we expect that backlog to increase considerably by year end. And why is that? There are 2 reasons. The first reason is that there is a very strong tendering in the cables market, both in offshore, with numbers being estimated above 5 billion euros for the rest of the year, as well as onshore, with the corresponding amount there being over or around 3 billion. Cables, Hellenic Cables, has already been picked as an exclusive supplier of 2 important projects, but since these contracts have not yet been signed, we do not include them in our backlog. So that's the first reason for an expectation of a higher backlog by the end of the year. The second reason is that there are other projects that we have already agreed with our clients, and either their final investment decision depends on funding from the client. I would just mention here the success that we are expecting from the share capital increase of the TSO in Greece, or the client is not allowing us yet to disclose the project because the final signature with his financial institutions are not over. So we are very confident that by the end of the year, we will show a significantly higher backlog. The potential for further increase is there and will materialize in the quarters to come. That is why we want to give you some information and to show you the development of our international expansion. First of all, starting from the Maryland factory, the US factory. I remind you, we are now building a land cables facility in Baltimore, Maryland. The rationale behind it stays the same and even became stronger in the last year. The rationale is that you have very strong fundamentals in the USA. These fundamentals can be described by different factors: the hardening of the grid, new interconnections which are necessary, the proliferation of data storage and data centers, the fact that more than 70% of the US grid is older than 25 years old, the damage which is caused very often by storms in the United States, and the different studies from research centers that show the electricity demand hiking up by more than 25% until 2030. All of these strong megatrends in the US find behind them a very strong support by the US policy. I am mentioning here the famous BABA Act, Build America and Buy American, which supports all direct investments in the country, and it leads to a very strong and powerful momentum. A Princeton study has concluded that the transmission capacity in the US necessary until 2050 should be more than 3 times what is existent right now. And another study by McKinsey has actually found out that we expect more than 2 times the current spending for electricity transmission by 2030. So this is a very positive macroeconomic background, fundamental growth. The US is a very scattered market. Just to give you an idea of how scattered it is, there exist in the US more than 2,000 publicly owned utilities, to which one can add around 800 cooperative utilities. I'm talking just for electricity. And the largest ones, which are another 170 of what the Americans call investor-owned utilities, meaning utilities that have shareholders widely spread. So we're talking about more than 3,000 different utilities, different DSOs and TSOs, compared to the 2 that we have in Greece or to a handful that most European countries have. To that number, we should add that the electricity market in the US has a lot of market participants. When I talk about market participants, we mean distributors of electricity, developers of renewables, installers of the grid, consultants around the electricity market, EPC contractors, and all of these have several modes of interaction with the cable or accessory suppliers. So it is not an easy market to be, it's not an easy market to grasp. At the same time, it's a very promising market. Data centers definitely represent a strategic growth opportunity for us. The demand is expected to grow more than 2.5 times until 2030, and the Maryland plant is really located at the epicenter of this growth, on the East Coast, close to Vermont and the other states where most of the data centers are now being built. That's why our local commercial team is very active on the field across all the channels I mentioned just before, so that our capacity addition is already very eagerly anticipated by the market participants. Now, as for the funding, as you all know, is secured until the end of 2026. We may have limited overruns in 2027 since the inflation, just the inflation impact over these 2 years from the time the share capital increase was realized until now has surpassed 10 to 12%. Plus, the scope has a little bit changed in our factory. We want to make it ready to receive some extra capacity if necessary in the future. And the timeline that we are looking for that plant is that by the end of 26, we'll start the installation of machinery and equipment. First quarter of 27 to produce samples for certification. I remind you that the local US certification for cables is indispensable. You cannot do otherwise. You cannot really sell cables in the US if you are not certified according to their own local specs. And finally, we expect that by the fourth quarter of 27, the substantial part of the factory will be completed. So what is really not the unknown point, but the point on which we're putting all our efforts right now, it is staffing. And the staffing plan is very active. For such a factory, we will need highly qualified and specialized operators, as well as technicians. And these guys, even when we will find them, we need some training to be able to produce the high quality cables that we are producing also in Greece. Turning to the other strategic investment that was realized in the last days of the Q1, the acquisition of the facility of steel pipes in Hartlepool in the UK. Hartlepool is close to Newcastle. It's in the Durham County. We're talking about a 100-year-old legacy plant that has served the steel community of the UK very well in these last 100 years. We're talking about an acquisition of the facility and the equipment, which came very cheap, around £10 million for a complete production line and LSAW production line with the competent workforce with it. Of course, it's a factory that needs optimization, that needs to be put back to operation, since for the last 9 months it was idle. But that facility has been and continues to be a trusted supplier of majors in the oil business, like Shell, BP, and so on, and can also support UK's projects in carbon capture. So for the local market, since we are now satisfying the local content clause of the UK, it will be a very positive addition. It can also play a globally important role for projects, especially on the other side of the Atlantic, since it gives our steel pipe segment a second plan with an LSO line of production, which is really important. I remind you, LSAW is really used in the high margin, high value projects and pipelines, because they are the pipes that are best for high pressure, therefore thick wall characteristics, for large diameter, for structurally demanding applications, and pipes that are highly reliable. That's why they are preferred as a solution for all the major projects around the globe. So what is in front of us now, right now? What are we looking at for the rest of the year? In the cable segment, the geopolitics that are right now running in the globe, and especially the war between Iran and the US, they support really further growth for us. What do I mean by that? I mean that in such an uncertain environment, the resilience of infrastructures is very important. We already have a backlog which gives us visibility until 2029. So let's see how that global geopolitical turmoil might add to that backlog and might add to that growth in cables. First of all, subsea interconnectors are not anymore viewed as energy projects. They are viewed as strategic infrastructure assets. And we have large TSO, transmission service operators in Europe, progressing with their plans of interconnection of electricity. And there are new private projects, so connecting individual countries in Europe We're talking about the Greece-Egypt here cable and so on, which are being proposed. Let's not forget that the Greek IPTO, ADMIE's 10-year development plan, talks about 7.5 billion euros worth of projects. We go to offshore wind. Offshore wind have been mixed in the past year. Certain European countries have experienced delays because of permitting, because of auction redesigns, and so on. But the medium to long-term outlook remains very strong. We have the Hamburg Declaration, that additional 300 gigawatts of offshore wind capacity by 2050, and a lot of European countries, France, Denmark, the Netherlands, among others, are moving towards new offshore wind auctions in 2026. Then we're talking about land cables. Now, land cables, the demand for medium voltage remains very robust, especially because of the need to continue the general electrification trend in urban and suburban areas by the European distribution operators. There is also a build out of data centers across Europe, not as strong as the US, but starting to show its growth opportunity. In that part of the market, we are also thinking about the VDS, the Greek regulator, 5 years investment plan, which amounts to almost 5 billion. The major trend, however, behind all the rapid expansion in cables is artificial intelligence and hyperscale data centers, mostly in the US, but also starting in a promising way in Europe. I gave you the numbers about the estimates of McKinsey and also estimates by other consultants. The number, however, which is expected in 2026 by the major hyperscalers in the US, I'm talking about Amazon, Microsoft, and Meta, they are discussing numbers around $600 billion in new data center infrastructure. And these infrastructure already translates into significantly higher electricity demand in the US. These hyperscale data centers can exceed 100 megawatts of capacity, and they involve several hundred kilometers of medium and low voltage power cable within a single data center, within a single hyperscale data center. Europe is moving a little bit slower. The direction is there as well. It's clearly the same. It will come a little bit later, that's for sure. But it is also very clear that electricity demand driven by AI is a long-term structural driver, actually for both our segments, since there are now, as we're talking, plans of building natural gas pipelines towards the centers where this data infrastructure is being built in order to have exclusive power generation for the data centers. So it's a very, very positive background for cables in the future. I should also mention here a positive development, which is that both the EU and the UK have taken measures against the unfair Asian competition. And this is important for us because, as I've stressed many times in the past, CENERGY and its companies are not afraid of competition. They have shown that they can actually play in that game and be very successful in it. We are all, however, worried about unfairness in that competitive game. And the measures by the EU and the UK are definitely a positive step, a step in the good direction. Turning to the steel pipes. Steel pipes, we should first of all reiterate the fact that natural gas still plays an important role. It's important to have secure and diversified supply routes, particularly for Europe, especially now that other routes of fossil fuel distribution may be closed for some time. There is a significant wave of new LNG export capacity in the US, a lot of projects in the US for that, but also in other countries. Across North America, the estimated investment pipeline exceeds 50 billion, and it is driven by that LNG exports. The most well-known example, or at least the widest, the widest distributed examples in the media is the famous Alaska LNG pipeline project, where Corinth Pipeworks is already a preferred supplier. I stress here that this is also not in our backlog, since the final investment decision has not been officially signed as we speak. Then we have the carbon capture market. The carbon capture market is in a scale-up phase. The expectation of the International Energy Association forecasts 80 billion of investment globally over the next 5 years. That is a 15 to 20% estimated annual growth rate throughout 2030. And we see that a lot of projects are starting in the US and Europe. And it is a very good opening for us, especially for our UK facility, since the UK is very active in such projects. Finally, hydrogen. Hydrogen is still gradual, is not really as developed as it was expected, 5 years ago. But there is some positive movement. In Germany, we have several onshore backbone initiatives coming into play. There are also offshore infrastructure plans being discussed, the most famous one being the Barcelona-Marseille subsea hydrogen pipeline between Spain and France. We are present there. I remind you that CPW was globally, the first company certified for high pressure, 100% hydrogen-ready steel pipes. And in the more traditional market outlook, we do have strong demand for large outer diameter pipes. These are the ones used for natural gas. We have steel quotas that will help our market. They are positive, the fact that you have steel quotas for Europe. CBAM may also contribute as a barrier of entry, mostly, not directly as a competitive advantage or disadvantage. We are therefore talking about a thriving market, but a very competitive market at the same time. The good thing is that Corinth Pipeworks is a top tier 1 supplier in that market, and it is one of the 2 or 3 pipe suppliers in the world which are considered capable of delivering high sophistication, difficult, high value projects. And this is very positive for us. As for guidance, we have decided not to update our guidance despite the very strong results of Q1. Now, should this trend persist in Q2, we'll come back to that in the June 30th results, which are due in the beginning of August. So here is the new financial calendar that I would like to show you. We have the 3 days, 22nd to 24th of June, all the dates related to the dividend payment. Then in the beginning of August, we have our H1 results. And on the 16th of September, we will have our interim report for the 6-month period. Then in November, Q3, and next year will be the yearly results for 2026. This concludes my short presentation on the trading update for Q1 26, and I'm turning now the floor back to the operator of the Euronext Athens for the Q&A session.